Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Marc Chandler. We're going to be focusing a lot on the continued decline in the US dollar and what it could mean for some other sectors that sometimes are correlated inversely to what the dollar is doing. The dollar is also following interest rates lower, and that ties in very nicely to some of Jerome Powell's comments, more or less locking in a September rate cut. The question is what degree that rate cut will be and what the follow up rate cuts will be throughout the rest of this year. Marc is the managing partner at Bannockburn Global Forex, also editor of the Mark to Market website, which I will post a link to in the show notes, and which I recommend checking out as Marc breaks down some of the key moves in markets and data points pretty much every day on his website. Marc, again, the US dollar, it continues to decline. This month has been quite bad for the dollar, down almost 3% and really close to breaking below that 100 level on the dollar index. How important is what the dollar does around here to you, Marc?
Yeah, sure. So as we're talking here today on Friday, the dollar index is making new lows for the year. This is really a continuation of the move that I would have beginning like this last leg down, probably early July, but it really accelerated. So maybe half the move took place more or less just since the middle of August. And I think the driver here is also driving other markets, and that is the idea that the economy is in a state where the Federal Reserve believes they can cut interest rates as early as next month. Powell's comments today at Jackson Hole reinforced that sense. He talked about that the pivot has been made. He didn't declare success and victory over inflation, but just about. And he did that by indicating that going forward, the employment market is more important. That mandate becomes more important because the Fed's confidence of reaching the inflation target has been improving. So bottom line here, the dollar is falling. It's been falling for some time, and that's really my concern is that with the falling dollar, of course, you've had higher gold prices, some higher industrial metal prices like copper, iron ore, which some people still think is more related to China than it is to the U.S. But in any event, the interest rate story helping lift stocks, weighing on the dollar, and I just am concerned that in the next couple of weeks, that the moves sort of reverse a little bit, that this dollar move, interest rate move, stock market move getting a bit long in the tooth. And so that would suggest a dollar bounce. And I'm looking at a lot of technical indicators suggesting that the dollar is oversold, sort of looking at momentum indicators like the MACD or the slow stochastics, even looking at the Bollinger Band. The lower Bollinger Band comes in a little bit below where we're currently trading, but well within today's range. So that means that for like the third day this week, the dollar is trading that lower Bollinger Band, just giving you a sense of how dramatic the dollar sell-off has been. And for me, giving some caution about trying to jump aboard this dollar express.
Yeah, duly noted, Mark, and it may be time for the US dollar to get a little bounce, but it's a dual-pronged approach where it's part US economy and financials, but it's also how the dollar relates to other global currencies, in particular the euro, the yen, the pound, Canadian dollar. How are you seeing the dollar in concert with the other currencies?
Well, I think that in this move, many people had, we're still recovering from the scar tissue from unwinding that yen carry trade. But I think that has morphed. So that yen carry trade unwind, say, second half of July through early August. But I think since then, it's really become a dollar move proper. I'd say sterling is really doing an incredible performance here. Sterling is making new highs, not only this year, making new highs for this year, but taking out last year's high as well, trading above 132 today. Sterling and the euro has really led this. They're really the two strongest currencies this year against the US dollar. I think that generally speaking, those currencies doing better, but the dollar block, like the Australian dollar, and you think about what's happening just in where we are in monetary policy. Australia and the UK probably will not cut interest rates next month. Neither will Japan. We can feel pretty confident about that. And I think we can feel pretty confident that Norway is not going to cut interest rates. But the other G7 countries, actually the other G10 countries, are likely to cut interest rates next month. So sterling benefiting from an economy that looks like interesting. After leaving the EU, many people got very pessimistic on the UK, and rightly so. But In the first half of this year, the UK economy has been the fastest growing in the G7. And the preliminary PMIs that came out this week suggest that it's still in a post position. That is, it's enjoying still some strong upward momentum as we move through the middle of Q3. So sterling looks attractive, but again, all these currencies, sterling, euro, Australian dollar, before the crisis or before the turmoil in the markets in July, the Aussie was near 7-month highs, and they have 68 cents. And it got down to maybe about 62.5 cents. And here we are today, knocking on 68 cents again. So we've had a big V shape, and it's really then that distortion by the unwinding of carry trades, I think that have messed people up for a while, and now people are trying to get back on with the trend. And my point is just that these trends are getting a bit stretched. You look at where they are versus the Bollinger Bands, you look at where the momentum indicators like the slow stochastics, the MACDs are, and it's telling you that this move is it didn't just begin with Powell's speech at Jackson Hole, but it's been going on for quite some time. And it's really, I'm hesitant about chasing the markets further from these levels. And so that means maybe that gold pulls back, maybe some of the industrial metals pull back. Oil might be a different story. I think that people are generally bearish oil. I think that's what the curve means. But I think it's the geopolitics and the hitting of another ship in the Red Sea. It looks like a bit of an escalation in the region. And that looks like it had helped oil put in a bounce here, regardless of what happened to the dollar in the last few days.
So, Mark, you said the UK, they've had some good economic data, but it really seems like we look around the world and the whole world is maybe in a slow growth mode, maybe even declining growth from some pretty good numbers we saw last year, even a couple of years ago. And central banks broadly are either going to not cut rates or cut rates. No one's really talking about raising rates here, maybe outside of Japan, but we all saw what happened when they tried that. Is any country outside, I guess, of recent UK data standing out to you as bucking the trend here, or is this really just a global picture that we're looking at?
I think it's pretty much a global picture, but I'd say that for me, the story really is like, it's the same old story, except there is one moving piece. And I think that moving piece is the US. I think that the US has gone from like a top performer, high interest rates, and the market anticipates that that the easing cycle that's going to begin next month could carry well into 2026. And so the US is the moving piece. Of course, Europe's not growing. And I think that's what the PMI show that if you make some allowances for the Olympics in France, the PMI in Europe is still showing a stagnant economy, more or less, in the Eurozone. I think that what's happening in the global capital markets doesn't seem to be happening because some better news in Europe, even though the European stock markets continue to rally as well. The real thing, I think, is not that there's good news from abroad, but bad news from the US, or what people perceive to be not so much bad news now, but bad news coming.
Well, Mark, when you look at the interest rates already pricing in, let's just say the high threes the last couple of weeks, have they already priced in all of the Fed cuts out to 2025 and 2026 at this point? Or do you think that the interest rate market could go even lower in rates, anticipating these cuts finally starting?
Yeah, I mean, look what the Fed funds futures are saying. They're saying that by the end of next year, that the implied rate Fed funds would be close to 3%. The effective rate right now is 5.33. So you're already pricing in fairly aggressive Fed easing through next year. And then if you go out further till 2026, you sort of see that it looks like the market's betting interest rates bottom sometime in the first part of 2026 near 3%. I joke about this, but it's true. I don't even know what I'm eating for dinner tonight, let alone where Fed funds are going to be in a year and a half or so. I do think that the Fed doesn't do things one at a time, and I do think that so as the economy eases, as the economy slows, and I do think that we shouldn't expect a linear pattern. That is, if I understand Psalm's rule correctly, we can reach some inflection points, and I think this is true for the other economic data as well. That after you reach a certain point, it's sort of like accelerate gets worse. And what I'm looking at really, I tell you what I want to focus on is it seems to be a story that's brewing, and that is that U.S. is importing more goods, and those goods are going into inventory. And on the surface of it, it looks good for GDP. But it seems to me that the business cycle, despite how sophisticated we are, the it seems to me that the downside of the business cycle is often driven by the liquidation of inventories. And so I'm watching the inventories build. And right now, of course, with what looked like the rail strike in Canada, possible dock workers strike in the U.S., Middle East tensions. I think that a lot of U.S. businesses wanted to stock up. Maybe it's holiday sales, but many businesses wanted to stock up in inventories. Maybe it's defensive, protect their supply chains, and so that's what's helping the economy now, giving it, putting lipstick on it. And then I think that as those inventories are liquidated, the U.S. economy weakens. But I do think that we should expect a series of Fed rate cuts. And like I say, who knows how long they last for, the magnitude. But I think that prudent to look for those rate cuts through 2025 and into 2026.
So, Mark, yes, it is tough to forecast what you're having for dinner tonight and even what the Fed is going to be doing in a couple meetings, let alone next year, a couple years out. But if we are in this path where you do see data getting weaker, and quite frankly, it sounds like maybe a recession on the horizon, but rate cuts coming when that recession is here, how big of an impact can that have to markets? Can markets weather a recession in the world of lower rates, or at least rates moving lower?
Well, yeah, this is a problem. On the tightening, people are now more comfortable with the idea that the impact takes place with lags. And Powell has gone out of his way to really stress that it works on the same way as interest rates are being cut. So, of course, as interest rates are being cut, say they begin getting cut in September, that the economy is going to still weaken while the Federal Reserve, because remember, the first several cuts that the Federal Reserve gives us is not really easing monetary policy. It's really just removing some restriction. Monetary policy. So if you just think about it, just as like sort of a quick kind of crude way to do it, take the Fed funds rate right now 5.33, sort of the middle of it, subtract inflation from it, and you find out that this type of quick down and dirty measure of real interest rate is unusually high. And it's not just high by 25 basis points. So that means that even after September, policy will remain restrictive. We probably have to get into next year, maybe even towards the middle of next year, before I'd say policy becomes looser as opposed to less restrictive. And so I think we should expect slowing of the economy. I think we will reach some level, maybe it's later this year, where we get a jump in unemployment. But the real story, I think, for us who are trying to live on in the short term and try to live on our trading and our investing, that this move both on interest rates, the dollar, stocks seem to be relatively extended. And when I look out to the next batch of important data, what is it? Jobs data on September 6th. And there I think people are comfortable with the idea that the jobs data from July that was released in early August probably overstated the weakness of the jobs market. There was some weather-related natural disaster type things that may have weighed on the non-farm payroll number. And so bottom line here is I think that we should be prepared for stronger jobs number and maybe even a decline in the unemployment rate. And it's a bit early. The jobs data is still a couple of weeks away, but the preliminary median forecast on Bloomberg among the economists they survey shows a 0.1 of a point downtick in the unemployment rate. And then if you look out to the next important number after the jobs, would be the U.S. inflation report. That also will be seen before the FOMC meeting on the 18th. And there, I think the early call is for stable to maybe even a little bit higher CPI. So the news stream, what we're kind of familiar with for driving down interest rates, driving stocks up, driving the dollar lower, has been the idea the U.S. economy is weakening. And I'm suggesting that in the next batch of key data might be the exact opposite of the current narrative, with lower unemployment and sticky inflation.
All right, something to look forward to. Very interesting, Mark. As we know, markets don't move in straight lines, and it seems like neither does economic data, but we need to pay attention to some of the bigger trends, something that you do a great job keeping us up to speed on. Again, Marc is the managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. That link is in the show notes. I recommend you check out Marc's website on a regular basis. Marc, thank you very much for your time today. I hope you have a great weekend.
Thanks. Good luck to everybody.